I need you to look at what is on your screen right now. Left side, that is silver's price over the last 4 days. $110 down to $82, a 26% drop. That is $28 per ounce gone in less than a week. Right side, 3 of the largest government mints on the planet, all showing the same thing. Out of stock, suspended, delayed. Now, let me ask you a simple question. In every market you have ever seen, stocks, real estate, commodities, when the price drops 26%, what happens to supply? It increases. Sellers flood the market. Product becomes available. That is basic economics. Supply and demand. It has worked that way for centuries. So why is the opposite happening right now? The price just crashed. And at the exact same moment, the mints that produce physical silver, government institutions, not speculators, are shutting down sales and rationing inventory. That does not happen in a functioning market. That is a symptom of something breaking. And today I am going to walk you through the receipts. Not theories, not predictions. Just the transaction trail. Where the silver is going, who is moving it, and what the numbers actually say. Let's follow the money. This is Global Money Report. If this is your first time here, this channel exists to track the transaction trail when the headlines stop making sense. Right now, silver is breaking in real time. Not breaking as in crashing. Breaking as in the system itself is malfunctioning, and the way you see that is not by listening to what people are saying. It is by looking at what they are actually doing. The receipts, the vault withdrawals, the delivery failures, the premiums they are willing to pay. By the end of this video, you are going to see the complete transaction chain, from the moment silver leaves an exchange vault in Shanghai to the moment a dealer in Mumbai tells a customer, "We cannot deliver your order." And you will understand why this is not a temporary spike. This is a structural break that has been building for years. Let's start with the withdrawals. Let's start in Shanghai, because that is where the most concrete, time-stamped data exists. The Shanghai Futures Exchange publishes daily silver vault inventory. This is not speculation. This is a government-regulated exchange reporting exactly how much physical silver is sitting in their warehouses available for delivery. As of February 3, 2026, the Shanghai vaults held 449.65 metric tons of silver. That is approximately 14.45 million ounces. Now here is what makes that number extraordinary. One day earlier, February 2nd, the vaults held 462.62 tons. In a single 24-hour period, 12.97 metric tons disappeared. That is 416,000 ounces withdrawn in one day. From one exchange, not sold, withdrawn. Meaning someone took physical delivery and moved the metal out of the public system into private storage. Now, who does that and why? When you take delivery from an exchange, you are not flipping it for a quick profit. You are paying warehouse fees, logistics costs, insurance. You are committing capital to hold a physical asset. People do that for one of two reasons. Either they need the metal for immediate industrial use, manufacturing, solar panels, electronics, or they believe the current price is significantly below what that metal will be worth in the future. So let me ask you, if someone in Shanghai is withdrawing 400,000 ounces per day while the paper price is crashing, what does that tell you about what they think silver is actually worth? This is not theory. This is a transaction receipt. Someone paid the premium, paid the logistics, and took the metal out of the system, and they are not the only ones. Now let's look at the mints, because this is where the supply chain visibly breaks down. Perth Mint, Australia. On January 29, 2026, before the price crashed, when silver was still trading around $110, the Perth Mint sent a notice to their wholesale distributors. Here is the exact language, and I am going to read this word for word because every word matters. Let me highlight 3 phrases. Increasing worldwide demand, not decreasing, increasing. Large backlog of orders. They are not trying to sell more product. They are trying to fulfill the orders they already have. Pausing wholesale orders until February 23rd. That is almost a full month. A government mint, one of the largest in the world, is telling the global wholesale market, we cannot take your orders right now. Now think about the timeline. That notice was sent when silver was at $110. Within days, silver dropped to $82. If you are a buyer, what did you just see? You saw a 26% discount on an asset that one of the world's largest mints cannot keep in stock. What do you think every smart institutional buyer did? They bought. They bought everything they could find. The crash did not reduce demand, it created a buying panic. U.S. Mint. The U.S. Mint suspended all numismatic silver sales on January 30th. Their website showed temporarily unavailable. Customer service told callers they were updating prices. Here's what actually happened. Silver was moving so fast that the Mint's pricing system could not keep up. They were selling American Silver Eagles at prices that were below what silver was actually costing them to produce. They were losing money on every sale. So they stopped. They suspended everything. When products came back online, the 2026 American Silver Eagle, which was supposed to retail around $91, was repriced at $169. That is an 86% price increase overnight. Not because silver went up 86%, because the Mint could not source physical metal at the paper price. The paper market said silver was $82. The U.S. Mint, the official government mint of the United States, was pricing it at $169. Which number do you think reflects the real-world cost of acquiring physical silver right now? India. This is the most alarming one, because in India, dealers are not just running low on stock, they are defaulting on deliveries. That means customers are placing orders, paying in full, and then being told, "We cannot fulfill your order." Amazon India sellers are canceling silver orders after payment has been processed. People are posting receipts online showing payment accepted, then order canceled days later with no explanation. This is not a supply hiccup. This is a delivery system breakdown. So now we have three failure modes happening at the same time. Perth Mint, rationing due to overwhelming demand. U.S. Mint, repricing 86% higher because they cannot source metal at paper prices. India, delivery defaults because dealers cannot fulfill orders. That is not three isolated problems. That is one systemic problem showing up in three different places. Now let's talk about what people are actually paying for physical silver, because the gap between the paper price and the real-world price is widening every day. The paper price, the spot price you see on Bloomberg, on trading apps, on financial websites, closed today at around $92 per ounce. But if you are actually trying to buy physical silver right now, real coins, real bars, here is what buyers in different regions are paying. Shanghai. Physical silver is trading at a 12% to 13% premium over the LBMA benchmark. That puts the real acquisition cost around $103 per ounce. Japan. Premiums have reached 60% over spot. That means buyers are paying closer to $147 per ounce for deliverable metal. Dubai. 40% premium over spot. Real-world cost, approximately $129 per ounce. The paper market says $92. The real world is paying $130, $145 higher. Why would anyone pay 40%, 50%, 60% above the spot price? Because they know that the spot price is not the real price. It is the price of a futures contract, a promise, a piece of paper that says someone will deliver silver at some point in the future. But when you need actual metal, when you need it now, when you need it in your vault, the paper price does not matter. The availability matters. Now let me show you one more number, because this is the one that confirms the entire story. Silver lease rates. A lease rate is what it costs to borrow physical silver. In normal markets, when there is plenty of silver available, lease rates are near zero, sometimes slightly negative. Right now, 1-month silver lease rates are trading at 3.4%. That is not the peak. At the height of the volatility in late January, lease rates spiked as high as 8%, and in some reports over 30%. Why would anyone pay 3%, 8%, 30% just to borrow silver for a few weeks? Because physical silver is so scarce that holders are demanding enormous premiums just to temporarily lend it out. When lease rates spike like that, it means one thing: there is not enough deliverable metal to go around. This is not speculation. This is the market itself. through prices, telling you that the physical supply is tight. This did not start last week. This has been building for years, and the data has been public the entire time. Silver has been in a supply deficit for 6 consecutive years. Every year since 2020, the world has consumed more silver than it has mined. Global mine production is approximately 835 million ounces per year. Total demand, industrial use in solar panels, electronics, electric vehicles, medical devices, plus investment and jewelry demand, exceeds 1 billion ounces annually. That is a gap of over 165 million ounces every year. Over 6 years, the cumulative deficit is roughly 800 million to 1 billion ounces. Where has that extra silver come from? Above-ground stockpiles, vault reserves that were built up over previous decades, recycling, existing inventory being drawn down. Think of it like a reservoir. For 6 years, more water has been flowing out than coming in. The reservoir has been slowly emptying. This week, the reservoir hit a critical level. The buffer is gone. The cushion is depleted, and now we are seeing the consequences. Mints cannot source metal fast enough. Vaults are being drained. Premiums are exploding. Lease rates are spiking. And here is what makes this different from previous silver rallies. Industrial demand, particularly from solar energy and electric vehicles, is not going away. It is growing. The structural deficit is not a temporary blip. It is a trend that is accelerating. Solar panel production alone consumed over 230 million ounces of silver in 2024. That number is projected to grow as countries push for renewable energy targets. Electric vehicles consumed another 90 million ounces in 2024, up 20% from the year before. This is not speculative demand. This is industrial consumption, real manufacturing, real production lines that need physical silver to function, and that demand is not price sensitive. A solar panel manufacturer cannot just decide to use less silver because the price went up. The silver is built into the design. It is required. So when you combine 6 years of cumulative deficits with accelerating industrial demand and a paper market that trades 100 times more silver than physically exists, you get what we are seeing right now. A system breaking under the weight of its own contradictions. Now, this has happened before. Not exactly the same way, but similar dynamics, and it is worth understanding what happened then because it tells us something about what could happen now. In 1979 and 1980, silver went through what is still considered one of the most dramatic price moves in commodity history. In 1971, silver was trading around $1.50 per ounce. By January 1980, it peaked at $50 per ounce. That is an 800% increase in less than a decade. What drove that? The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, began accumulating massive amounts of physical silver. They were not speculators. They were not trading paper contracts. They were taking physical delivery, storing the metal in warehouses. Their thesis was simple. They believed silver was undervalued. They believed the paper market was suppressing the price. And they believed that if they accumulated enough physical metal, they could break the paper system. And for a while, it worked. As they took delivery, physical supply tightened. Lease rates spiked, premiums exploded, dealers could not source metal. Mints ran low on inventory. Sound familiar? But here is what ended it. In January 1980, the COMEX exchange implemented Silver Rule 7. This rule did one thing. It restricted how much silver could be bought using leverage. It essentially cut off the Hunt brothers' ability to continue accumulating. Within weeks, silver collapsed from $50 back down to $10. Now, I am not saying we will see that exact scenario repeat. The rules are different now. The players are different. There are circuit breakers and position limits that did not exist back then. But the fundamental dynamic is the same. When physical supply cannot meet physical demand, the paper market eventually has to adjust. The paper market can manipulate prices. It can suppress them. It can create artificial crashes like we saw last week. But it cannot create physical silver. It cannot mine silver. It cannot manufacture silver out of thin air. And based on what I am seeing, mints shutting down, vaults draining, lease rates spiking. I believe we are getting very close to the moment where the paper price has to catch up to physical reality. So, what do you actually do with this information? I am not going to tell you to buy or sell. That is your decision. But I am going to give you 3 specific things to track going forward, because these are the data points that will tell you whether this situation is resolving or escalating. The Shanghai Futures Exchange publishes daily silver vault levels. This is public data. You can see exactly how much silver is being withdrawn every day. If withdrawals continue at the current pace, 10 to 15 tons per day, the vaults could be empty within a month. If withdrawals slow down and inventory starts rebuilding, that tells you physical demand is cooling. Right now, the data shows accelerating withdrawals. That is a tightness signal. I will link the data source in the description below so you can track it yourself. Pause. Second, track silver lease rates. Lease rates near zero, around 0.3% to 0.5%, mean the physical market is functioning normally. There is enough silver to go around. Lease rates above 3% mean stress. Above 8% means crisis. Right now, 1-month lease rates are at 3.4%. Still elevated, still signaling tightness. If lease rates normalize back to zero, that tells you the physical shortage is easing. If they stay elevated or spike higher, that tells you the opposite. Again, I will link the data source in the description. Watch what physical buyers in Shanghai, Dubai, and Japan are actually paying over spot. If premiums are 10%, 20%, 40% above the paper price, that tells you the paper price is not the real price. If premiums normalize back to 2% to 5%, which is typical in functioning markets, that tells you physical supply is catching up with demand. Right now, premiums are still elevated. Shanghai is 12% over spot. Dubai is 40% over spot. Japan is 60% over spot. The paper price and the real-world price have not converged yet. Those are the 3 metrics. Shanghai vaults, lease rates, regional premiums, watch those. They will tell you more than any price chart or news headline. We started this video with a simple observation. The price is falling, but you cannot buy the product. Now you have seen the receipts. Shanghai vaults draining 13 tons per day. Mints implementing rationing. U.S. Mint repricing 86% higher overnight. Buyers in Dubai paying 40% premiums. Lease rates at 3.4% when they should be near zero. I am not here to tell you what silver will do next week or next month. I am here to make sure that when you make a decision, whether you are buying, selling, or holding, you are making it with the full picture. Not just the paper price, not just the headlines, the entire transaction trail. If this was useful, subscribe to Global Money Report. This is what we do here. Follow the receipts, track the data, and show you what is actually moving when everyone else is distracted by the noise. If you have questions, or if you are seeing something in the silver market that deserves a closer look, drop it in the comments. I read everyone. I will see you in the next report.